What's up, everyone? In this video, I want to talk about how I trade using supply and demand, why I feel as it's the best trading strategy. I have a lot of success trading this way because supply and demand can be used as a core for other tools to add to your arsenal. Supply and demand is how any market, specifically the stock market, facilitates trade in the auction place. And supply and demand removes your emotions out of any of your trades because it gives you a definitive edge. We're also going to get into a bunch of chart examples in this video. But if you are new here, make sure to subscribe to my channel, hit that thumbs up button, let's try to break the record, and be sure to follow me on Instagram. I post daily trading recaps on here, along with very good trading tips and tricks. The link to this will be in the description below. You're definitely missing out if you aren't following this resource. And now, let's get right into the video. It's very important for all of you to understand the auction place and understand that the market moves because price imbalances where demand exceeds supply or supply exceeds demand. It's economics 101 for those that haven't taken economics even in high school. Prices move because of the supply or demand equilibrium or the equation being out of balance. So if we have a large supply of something, there's an excess of a good. In this case, we could talk about a stock, and there's not enough demand to meet that supply. Price is going to move down to an area where price or the participants find it to be a fair price and they agree or balance out the auction. Now, if supply is not strong enough and you have a lot of demand for an item where the supply or the excess of goods does not meet that demand, there's more people looking to buy something than sell it, then prices are going to go up because more people are willing to pay at a higher price. It's economics 101. Now, this is all going to relate back to the chart, but this example, we could look at a supply of someone selling bananas. Think of this as the market and someone looking to sell something. Now, we own 100 shares of Apple. This is our supply. We are passively sitting on the offer, waiting for an aggressive buyer or demand, which is these people, to come and hit our order or take away our bananas from the market. If there's a lot of people in line looking to buy a stock, looking to buy a good, and if there are not enough bananas to meet that supply, then prices are going to go up because the people in the back of the line are going to pay a premium because they know the people in the front are going to be guaranteed to get that item. Now, in this case, if there is a large amount of supply or there's a large amount of bananas and there's only one or two people in line, there's not a big enough demand, what's going to happen is price is going to go down because you're going to have the sellers not have enough demand to meet that supply and price is going to move down. Now, this relates back to the market. Pull up TOS here. Because of price imbalances, the second step is to find these price imbalances on a chart. These essentially give me my where aspect to where I want to be a participant in the market. These are different than support and resistance. These are price imbalances. These are areas on the chart. Now, I look for specific ways to find these zones. I teach this for Invest the Trade members, but briefly, I'll just show you some examples. So this was an area where the market was in equilibrium, and then we got that push down, giving us the indication that sellers were in control, and then this validated a supply imbalance where at the first 5 minutes of the market open today, we tagged it perfectly. It was basically the high of the day, and now we need price and volume to confirm when we want to be active and take this trade. So ideally, since we're trading at supply, you want to play a bearish position because this is a high quality area that the market can move down because of past existing price action. Now, you could trade the future outright, ES. You could trade SPY puts, which is what I do and I recommend. This works for any market, any stock, any future, crypto. It does not matter. It's how any market facilitates trade. And then we also have on the flip side, demand imbalances. Now, these are areas where the market was in equilibrium, followed by an extreme push by the buyers that made the demand exceed supply. For example, in this case, in this rally up, and another one in this area. One thing I will want to mention is I manually draw these zones. It's not magic, but it gives me my where, and then I use some confirmation features to tell me when and when I physically put a trade on and enter a position when I have real skin in the market. The third step, which I do, is use price and volume to confirm these zones, and this gives me my confirmation to take the trade. I have a handful of confirmations that I do use. This essentially gives me my when component, and the zones give me my where. Without the two, I do not have an edge. Now, one thing I do want to mention is you cannot enter these zones blindly. These aren't magic areas that the market's just going to definitely bounce at. If supply was greater than demand at this demand imbalance, we're going to continue moving down. The key is finding proper confirmation at the zones, and I use price and volume to do it. Then I put a trade on. And this is where you could also get very creative and use this as a tool for other things to add in your trading arsenal. I've seen other traders use different indications, different confirmations, whatever works. Essentially, you could use whatever to add to your when component. Just understand that these supply and demand zones give me my where component. If you've made it this far and you're learning and enjoying the video, hit the like button. Let's try to break 800 likes on it. I want to see who watches my videos throughout. The fourth component is supply and demand gives me a defined risk. When price confirms it, it usually works out right away, and my risk is extremely defined. What I mean by this is, for example, Amazon sold off into this demand imbalance where we had some lower wicks, price began to bounce, and this moved up about 15 or so points from this demand zone. If we did take it long, this is on a 5-minute chart at this demand zone, and look exactly where we stalled out. Now my charts are completely naked besides VWAP and volume. Anything that relates always back to volume and price, I will use. VWAP does that, and the normal volume histogram does that as well. So VWAP is a good indication. That's not to argue that you can't use other things to add to your story, which will paint the picture that the market is essentially trying to reflect to you. However, once we reject back to VWAP, we come back into this demand zone. Now at this point, if we're looking to take the market long, let's just say we missed the first zone, the market retraces back into this demand balance, we could look to take the market long again, and I would define this extremely tight. So let's just say we take it long at the zone around 3428. We're playing the Amazon 340 or 3450 calls, let's just call it. We're long at 3428. Our target is VWAP, and then we have a target of high a day, which kind of I like doing. So 3426, our stop, if we're using low a day or we're using this little pivot low right here, is 3 points, 4 points, 5 points tops. And on a $3,400 stock, that is very little risk if we're trying to get a 15, 20, 25 point reward. So risk to reward makes sense. Win rates don't mean anything in trading. If you're risking at least you're risking at least 1 to get 3, you have a very good trade, and your edge does not have to win enough for you to be profitable. So if I'm entering this point, my risk is extremely defined, and you would have had a nice runner at this demand zone. Another example, here's Tesla. We had a demand imbalance last week at $673.90. All morning we sold off on it, nice volume to come down, consistently making lower highs, consistently making lower lows, and we come into this demand imbalance with essentially one of the highest volume nodes of the day. Then the market starts acting like there's a little floor that's stopping us from moving lower. This is an area, it's not support, it's a demand imbalance. And let's just say we find valid confirmation right here above 675. Our stop loss, if we're conservative, if you're scalping, is, let's just call it 673, maybe a little below low a day around 672.50. So we're risking about $2, $2.50 to potentially make $8, $10, $12. So risk to reward, it makes sense. This trade then does work out right away. Volume to confirm it, very strong move. And it's not a coincidence that we had news that came out and justified it with volume inside of demand imbalance. It's how the market works. It's how big money gets into their positions. As you can see, nice volume down here to confirm it, and then the market moved up. Now later in the week, or by end of the day, we test that again. The following day, look exactly what happens. We break out, very strong volume. I actually remember playing this to the long side after we had buyers factored in. So this kind of goes into my next step, which is you could find out where buyers or sellers are factored in. For example, this day we bounced off of this demand zone. Now the following day we come into pre-market, we bounce at it. We have buyers factored in at this demand zone. If they show any effort to get rewarded to the upside, the market should rally and we should have volume to confirm it. So this broke out of our wedge. It broke above the 685, 690, 694 area, and we were targeting 700, which it actually ticked. Nice volume to confirm it. And then eventually, once we've got a bunch of late longs, because you have to understand the retail participants mindset, once we have a bunch of people seeing a crazy move like this, you're going to have a lot of late longs longing the market. So it's essentially better to get in at demand or get bet in once we start speculating that demand is going to form. Because if you're late to the party, you're eventually going to get dumped on. The market knows where you're buying. The market knows where you're selling. You have to do it very discreet as possible. That kind of validates and goes back into the supply and demand equation, because that's essentially how the market works. Then we pull back into this demand zone, the same one that we bounced at yesterday, and the market bounced, did not show any real effort. However, this was a quick $6-7 move after coming into demand with strong volume, and then pretty much flat, all afternoon, just like it was the day prior. Like I said, there's many ways for you to get creative with it. A demand imbalance essentially just means it's an area where demand exceeds supply on the chart. That's not stopping price from coming into the zone. And if sellers are aggressive, there's more aggressive sellers into the market than there are passive buyers, then price is going to start moving down. So it's all about the reaction to the zone, because that same exact demand zone on Tesla that bounced at 2 days prior completely got wiped out today. So at this point, if you want to get creative, there's not enough support, there's not enough demand lower, you could potentially look to play a bearish position if the sellers are aggressively hitting the market. And you could have got a quick, 10 something points on Tesla today after breaking this demand zone. Now, this goes to this Amazon trade. This was a beautiful thing to see this morning. I took this trade long. This was from the pre-market plan. Now, I post these every single day in my Discord. We were watching Amazon today. We were right near all-time highs. We had a 3526 supply zone. That the key is to see the reaction at the zone and which participants are winning in the auction. For example, this is a supply zone. So if supply exceeds demand at the supply imbalance, we are going to reject. However, if demand exceeds supply here and we have more aggressive buyers than passive sellers, the market will move up. We were watching for a scenario that if we slice through the 3526 supply zone like it's not there, I'm going to be watching to play calls as we could test and break all-time highs at 3554 easily. So going into the market, I normally do not like playing the open. However, reviewing my journal, I've been seeing this common theme in the market where we break out, we have strong buyers at the open, we wipe past supply, and there's no reason to play calls as the market can play. So I played the Amazon 3600 calls at 9:31 today. Once we got above the 3554 area, played them at $24, and a minute later I sold at $34. So it was a quick 1 minute trade, and I made $10 on the premium. These extremely got jacked up. You had a lot of retail traders buying this. A lot of eyes were on it. It was a very fast trade, and it was a simple analysis, not so much shorting at supply, but understanding the auction process and seeing we had volume and seeing we had strong, aggressive buyers wiping out those sellers. And then eventually this was an all-day, essentially, runner. If you held a couple of contracts, these contracts at $20 earlier in the morning, I think closed at like 60 or even $80. So these paid big, very sick trade. I know a lot of members in the Discord made a complete killing off this, 5-figure days like crazy. So it was an awesome trade just by using that equation of understanding supply and demand. Now, the last point is supply and demand makes me emotionless in trading. It's my edge. It's what I know makes me money. For example, going back to this Tesla, or we'll do NQ. So NQ, this thing bounced off of demand today. So I know supply and demand gives me my edge. It's what makes me consistent money day after day. I have confidence, I have conviction in my trading. Now, you can't have confidence or conviction if you don't have a system and if you don't have an edge. And if you don't have those things, you are going to have emotions in your trading. And I could tell you from personal experience in my first 2 years of trading, still not perfect, still trade with some emotions. However, I'm using everything to not have the emotions that are detrimental to my trading success. A lot of people trade based off of emotions, their feelings, what they think is going to happen. And supply and demand gives me a definitive answer instead of letting my emotions and my brain tell me what to do. Point I'm trying to make here is to trade as emotionless as possible. Trade the market to trade your setups. Do not trade the market to make money. If you follow your edge, you trade your setups, the money is a byproduct and it will be guaranteed to follow. The minute you start chasing the money, you're going to be trading for the wrong reasons and your emotions are going to do all the talking for you and they're going to make trades. And I can guarantee you, you will not have long-term success if you let your emotions get involved and you cannot control them. So I think I'm going to leave you all on that point. If you did enjoy it, smash the like button, subscribe to my channel, be sure to follow me on Instagram, and also check out the links in the description below. I offer a very in-depth educational course that comes with access to the Discord at no extra cost. I do plan on raising the prices very soon, so definitely take advantage of what's on the site. But besides that, I'm out. Peace.